Welcome to the Confessions of a Recovering Landlord podcast, where we let you in on the secrets commercial landlords would prefer you just didn't know. Brought to you, as always, by our good friends at Riata Commercial Realty, where they represent exclusively users of office and warehouse properties. Landlords have representation. Do you? In today's episode, Cutting Edge. Can I just say, Jerome Powell talked today at 1:30, and it's now
Right to me.
2:30, and Jan and Bob Gibbons are talking. We're going to talk about inflation, what the Fed did, and how this is going to affect your lease. Before we talk about the impact on the space a company occupies, let's define some terms and be sure we know exactly what we're talking about with inflation, because I don't always think of inflation in a lease. I think of it at the gas pump and at Walmart and that kind of thing. So first of all, what is inflation?
Well, inflation is really nothing more than rising prices for goods and services. You know, you buy a gallon of milk and it's, I don't even know, whatever, $3 today. And then a year from now, it's $3.30. Well, that's gone up 10%. Therefore, you had 10% inflation on that one item. But if you take the aggregate change in goods and services in a country or a region or whatever, that is the inflation. The other way to look at that, however, the flip side of it is the declining ability of money to buy goods and services. Just like I said, you know, $3 today buys that gallon of milk. It won't a year from now. Therefore, the value of that $3 has fallen in terms of the what I can get in return for it.
Well, the most notable current commodity along those lines is gas. I mean,
Right.
Today I was driving by Walmart and I saw it at $3.89 a gallon.
Oh, that's not bad.
Well,
I mean,
how
compared
funny.
to,
A month ago, you wouldn't have said that.
oh, heck no. And a year ago, I would have been hyperventilating, but
Right.
I've seen it at, over $4 here in DFW. So yeah, that didn't sound as horrible as I was expecting.
Okay, so what causes inflation? Now that you've defined it, what is it? How do we get rid of it?
Well, I mean, anytime that you have, it's the classic supply and demand, right? So if you have more money chasing the same goods and services, you got to bid the prices up to get it from someone else. We see this in purchasing houses. You always hear about all these houses out there that, we had 15 offers in the first day or two, that kind of thing. It's kind of crazy. But when we look at what happened during the COVID in particular, you had the government flooding the country with money. They sent out stimulus checks. They gave money to businesses to keep people employed. The classic PPP loans, forgivable loans. It was really just a gimme that they gave to everybody. So that increased the money supply. And anytime you increase the money supply, you have more money chasing the same stuff. And therefore, you're going to have increasing products and services prices. And this didn't just happen in the US. This happened worldwide. I mean, all kinds of every other country, or I shouldn't say every country. I don't really know that, but I know, all the Western countries anyway, all did similar kinds of stimulus packages. So that is one reason for inflation. The other reason could be restrained supply. So, you've heard about all these supply chain problems throughout the last year and a half, 2 years.
Yes,
And
Fritos.
For what?
Fritos. I couldn't get Fritos.
Oh, that's right. Yeah.
I'm talking important stuff today.
You called me one day. It's like, I can't find Fritos.
It was a meltdown right in Walmart.
If you restrain the supply, somebody's going to say, hey, I'm willing to pay more for that.
Mm-hmm.
And in fact, it's interesting. Sometimes there's this concept called, I'm trying to remember the exact term. I remember from economics class, it was something about riding the supply curve or something like that. When you have small supply, when you're first starting out in a business, creating something new. Like I heard a podcast about oat milk of all things. So you have oat milk, and when it started off, it had very limited supply. Some people were willing to pay a whole lot for it. As there's more and more supply, you have to maybe drop your prices to get more people to buy it. And therefore you're kind of riding that supply curve And the more you have to drop your prices to get more people to buy it.
Okay, so when have we seen inflation in the past? And I don't mean last week.
Well, but we did have it last week.
Yeah.
Sadly, you know, there's almost always inflation to some extent, right? I mean, when have you ever said, hey, this is costing me a lot less than it used to? You know, now there have been times. I mean, you look at the personal computer, for example. In 1986, I bought, for the company I was working for, I bought a IBM compatible PC computer for $1,600. That thing was cutting edge at the time, but today it would be a piece of crap.
Dinosaur.
And the most recent computer I bought for our company cost probably 30% less than that. And that's over, what is this, 34 years, 36 years later. So that's a good example of, you know, deflation, something costing less in the future than it used to. But most of the time you expect you're going to see higher prices for the same goods and services. You know, the last worst time that I can remember was 1970s and early 80s. I remember my parents and I moved from Washington, D.C. to San Francisco in the summer of 1979. And not only had there been inflation, because, you know, if you go back to Lyndon Baines Johnson, who was the president after JFK was killed, he had this thing called the New Society, where it was the war on poverty. And he was trying to get a lot of people out of poverty. And one of the ways they did that was through social programs that injected a lot of money into the economy in the 60s and early 70s. So there was all that demand chasing goods and supplies. Sounds very similar to today. But then you put on top of that an oil embargo, which jacks up your prices of gasoline. Well, they had the oil embargo by OPEC. We have Joe Biden as president. And then on top of that, this war in Ukraine, both of which was restricting supply and increasing prices. So very similar situation. So the 1970s were pretty bad. In fact, when my parents later moved from San Francisco to Texas, I remember they bought a house and their interest rate was 15%.
I remember that.
15% is a mortgage interest rate. That's crazy. But I remember the first two houses that you and I bought in 1987 and 1989, we had 10% interest. When was the last time you saw 10% on a mortgage?
Right.
Then, because since then has been, you know, 3s and 4s and even 2s in some cases. It's just nuts. So anyway, that's kind of when we've had inflation. You know, if you were to have a situation, however, sort of again, the flip side, if you have prices falling in the aggregate, let's say a gross domestic product of a nation or a state or a region falls, that actually is considered a recession. And so we have had recessionary periods in history. I think the most recent one would have been 2008 and 9, but you know, those don't seem to last nearly as long as when, you know, whenever you're having an inflationary period.
So what do interest rates have to do with inflation? Why did the Fed make the move they did today?
Well, let's take the first part of that. What do interest rates have to do with inflation? So basically, higher interest rates make it more expensive to borrow money. So if you need to borrow money to buy something, the price of that item may not only have gone up because there's higher demand for that product, but now you have to pay more to borrow to buy that product. So now it's compounded. So ultimately, it just means that things are more expensive to buy. And when things go up in price, fewer people have the ability to buy it or are willing to buy it. One of the two.
Let me correct you on one thing. You're saying things get more expensive. Actually, things will become less expensive.
Well, you're getting ahead of us.
To purchase them. Okay, well.
But you're kind of getting ahead of it, because right now, when things are still increasing in price and you layer on interest rates that are higher, it makes that product more expensive on top of a higher price. So yeah, it makes things more expensive. So the less people buy in the future, now we're getting to what you're getting to. If they're going to buy less, then companies don't need to produce as much. And if they don't need to produce as much, they don't need to hire as many employees. And they might even lay off employees, which means we have unemployment. They may not need to, buy other goods and services, raw materials, let's say, to buy stuff. They may not need to buy a new machine to produce as much because there's not as much demand. So ultimately, increasing interest rates puts downward pressure on the demand for goods and services.
Yes, and which makes it for the cash buyer a sale time.
Great opportunity,
on
right?
Sale for the cash buyer. So
Another-
it can be, even though it can be a tough time for some, it can be an opportunity for others.
And that's one reason why you should never go into debt. If you can avoid going into debt, then you have money.
Well, especially for consumer goods. If you're buying an asset product, going into debt isn't always bad.
Well, yeah, I mean, if you're buying an appreciating
Right.
asset, yes. If you're buying anything that is going to hold its value steady or depreciate, you probably shouldn't buy on credit. But either way, if you have money sitting on the, sitting ready to be deployed in some great dry powder, exactly. In the case of a war analogy, sadly.
So with what happened today, you're basically saying that the Fed hurt the economy on purpose.
That's exactly right. They're putting the brakes on the economy to slow it down, because if they don't, and we continue in this mode where we have cheap money, where it doesn't cost much at all to borrow stuff, and prices are going up because of demand, it's hard to break out of that cycle. So they're trying to force a higher cost on borrowing money, and therefore restrict output, production, purchasing of goods and services, and therefore that will slow down the economy to help break the inflation that would otherwise continue.
Kind of reminds me of riding in the truck with you. Bonk.
What are you talking about?
When you tap those brakes, you aren't always the smoothest in town, and boom, I go forward and get smashed up against that seatbelt. And that's basically what Powell did today. And if it doesn't work, he'll do it again.
Hey, if you want to ride in a truck with,
he'll do it again.
You want to ride in a truck with Powell, just let me know.
I don't like him touching my money. I ain't letting him touch my truck. Okay, so down to the bottom line of how this affects us and our listeners. What will this do to commercial real estate and spaces people occupy?
Well, first of all, nothing is a one size fits all. So, it's not going to affect everybody exactly the same. Some businesses are counter cyclical, meaning they do better during high inflation periods, and others don't. Most don't. But in general, in the aggregate, if they aren't hiring new people or producing as much product, then it will probably mean they don't need as much space. Either they don't need to grow into more space, or they don't even need the space they have, or at least not as much of it. And therefore it should slow down demand for space. So in the case of, let's say, industrial space, you're not producing as many goods and many products, therefore you don't need as much space. So we've seen, absolutely crazy on fire industrial prices, rental rate growth. I'll give you a very painful current story on this. I got a proposal yesterday for a client who leases an industrial warehouse in the Dallas-Fort Worth area. Their lease is expiring after 5 years, and their rental rate is going from $5.69 a foot to $8.10 a square foot.
Shut up.
That's a 42% increase.
Okay.
Now,
are you getting any TIs? Are you getting anything for that? That's just base rent going up.
This is the proposal that the landlord gave us. So we didn't need any money for improvements. They didn't offer any free rent. And by the way, that was the first year at $8.10. Then they wanted a 4% bump every year thereafter. So bumps every year is not unusual. It's usually either going to be, anywhere from 2 to 3%. Maybe it's 25 cents per square foot per year, it depends on the lease. But in any case, my first response or reaction was, before I tell my client what this landlord's proposing, I need to know what else is out there. And so I started looking around and calling around, talking to a bunch of leasing agents. And guess what? $8.10 was on the low end of the range. The range I found started at $750 a foot for this area that we were looking at anyway. $750 a foot was the lowest I found. And it went up into the mid-teens, like $13, $14.
For the same
And
product.
for the same similar type of product. Yeah. So at $8.10, it's like, well, goodness, I have a hard time even arguing this point, right? Now we of course will. We're always going to try and negotiate.
Oh, yeah.
But that's a real current painful example. So if that 42% increase in the rent for that deal means they can't afford to buy a new truck, hire a new employee, whatever, you know, they've got to make some choices maybe under constrained resources. Or if now the interest rate on their line of credit has suddenly gone up, as well as this, now you got a double whammy.
So do they look for other places? Do they look for not as much square footage? What is recommended?
Well, I mean, it depends on that particular tenant's situation. And, you know, there's not a one size fits all, but, you know, one of the things I suggested was, would you consider going to a different part of town? Because a different part of town might have some lower costs associated with it. Now, there may be some other issues with those other parts of town. If it's farther away from their customers, well, maybe the cost of fuel, gasoline to get to diesel to get to those other parts of town will be more than the increased rent if they stay where they are. If they can't get their employees to get there, or if they have to pay their employees more to get to a place that's farther away, you know, so again, you can't make these decisions in a bubble as if everything else stays the same, because it doesn't. So, so that's the situation in an industrial building. In an office building, this is where it gets really interesting, because we've already seen far lower demand for office buildings over just because of COVID. Now you throw in higher interest rates, and people may not be, you know, hiring as many employees. You also have the situation of, all right, if I wanted to buy a building instead of lease it, well, it's going to cost me more to borrow. And can I afford to do that? Can I buy as much building as I was before, or in the right, you know, location that's ideal for my customers and or employees? So
let me ask you a question related to that. Usually with home prices, they're what's the word I'm looking for? Inversely related to the cost of getting the money. Is it the same for offices? Like with a home, the price goes up when the interest rate falls. Interest rate falls, the price of the home goes down. Same with office, or?
Well, again, if everything else is equal, you would think the answer to that should be yes. Because if interest rates go down, I can buy more house than I otherwise planned, or I can buy more office than I otherwise planned. I mean, same thing when you have, in the current market today, you have 10 or 11 million square feet of office space on the sublease market. Well, because of that discount on a sublease, I can buy I can lease a much nicer building than I otherwise would. You got to be careful with that, because when that sublease expires, now you've got your employees all used to, and your customers too, and in that case, coming to a much nicer place. And now you're going to go back to the kind of space you could actually afford. You know, you went from a really nice subdivision to a mobile home park, you know, so that could be a problem.
Nothing wrong with a mobile home.
No, nothing wrong. I don't have a problem with it either. I'm just saying that it's a different image.
Yeah.
That's all. So you got to be careful with all that. So bottom line to all this stuff is that higher interest rates mean more cost to borrow money. So the cost to buy will go up in the short term if you have to borrow. If you're leasing, you know, it can kind of go either way depending on the circumstances and other factors in the market.
So you're indicating that the industrial segment is not going to be hurt by what happened today?
No, actually, I'm not saying that. I'm saying that industrial probably has, I would argue that industrial has as much risk, if not more, than office in this environment, because, you know, they have cost of raw goods, raw materials is what I'm looking for. So they have the cost of raw materials with commodities, which has been going up fast. They have a lot of gasoline and other fuel that has been going up fast. Now their cost of borrowing is going up, and it's hard to hire, which it was already hard to hire. They've got a whole lot of factors that are hitting them all at once. If somebody's an office user and doesn't have the manufacturing and transportation component, they may have fewer components that are hitting them all at once. So I'm actually arguing that industrial could have a greater strain on it and a more downward pressure on prices and rents than office. Now, if you say, all right, in industrial, we're going to go from absolute crazy panic buying and, I can't get enough space, to just sort of, all right, we're going to back off by half. Well, it's still high demand. So, it's all relative. Okay. So, I think industrial is going to be fine for the immediate foreseeable future, but I think there's more room to play in the industrial than there is in office.
So what I'm hearing you say is now more than ever, you need a tight relationship with your well-experienced tenant rep broker. Would I be reading that correctly?
I like the way you can read me. I mean, I guess my advice for people is, when they're trying to make a decision on space, if you can buy. Buying is still cheaper than leasing, and interest rates are still very low in the big picture, in the big scheme of things. I mean,
right.
Even with the Fed increasing their Fed funds rate by 0.25%, mortgages are still crazy low. And if we run the math to say, should you lease, should you buy, buying is still going to be cheaper. Again, all things being equal. Assuming you have money for a down payment, assuming you can qualify for the loan, assuming you don't need that cash for something else, assuming you can predict your growth for the next, 5 to 10 years, and, move into a building and then say, oh goodness, I need to sell in a year or two. So dealing with all those things, assuming everything else is the same, yeah, buying is the cheaper way to go. It also means, can I even find the building to buy? And that's the biggest problem right now. If you're an industrial user and you want to buy, that is a really, really hard thing. Yeah, get in line. That's exactly right. I mean, we put a building on the market, an industrial building on the market last week on Monday morning. And when I say put it on the market, I put it into the online database that all the commercial people use, the commercial MLS, if you will. Before the end of the day, we had a call from somebody saying, hey, I'd like to have a tour. So we toured them the next day, got another call, toured that prospect on Wednesday. The people that toured Tuesday had an offer to us Tuesday night. We traded contracts, traded paper back and forth on Wednesday. That deal got signed on Thursday. In the middle of all this, I'm getting tons of emails and calls. And since then, I continue to. So in the last, call it 9 days, 10 days, we've had probably, 3 dozen inquiries on the building.
One from a broker who couldn't even get her client to come view it because they were out of town.
Oh.
But she said, please let me come videotape it and send it to my client. I don't want them to miss out on this opportunity.
Yeah, the client was on spring break vacation. You're right. And so, I mean, that just kind of tells you where things are in industrial. So even with an increase in interest rate, all right, so instead of 3 dozen calls, we get only 30 or 25. Does that mean we can't sell it? No, it's still there. It just may not be quite as frothy as it currently is.
Great. I'm dealing with a Brit now. Okay. I think on that foreign note, we'll shut this bad boy down. Again, we'd like to thank our sponsors at Riata Commercial Realty for bringing this volume of information to you. As always, we're here to service you in whatever type of needs you have, office, industrial, or warehouse.
Thanks for being with us today. We'll see you next week with another episode. And as always, you can find us at texastenantrep.com.
Bye.